Greetings, Jonathan Camarda. Hopefully you're all having a great summer. Maybe on a cruise ship, in a hotel with family, maybe on a raft in the pool with a nice cold drink. As you can see, I am not at this point enjoying. So please, I'll live vicariously through you folks. So let's get started with what was, no pun intended, pretty hot numbers last week on Thursday, and the jobs numbers, and then not so much Friday. So the Thursday numbers last week, the ADP numbers, which are not a great predictor of future job movements and such, yet the news stations like CNBC, they just love to over-report them. In fact, they're pretty much just guaranteed and locked in due to that over-exaggeration. The Fed going 25 basis points in July, over 90% now. So we're going to go ahead and say that that's a given. Now, what you saw is those very hot numbers on Thursday, ADP, and then the BLS numbers on Friday, right? And some folks want to take the L out of that BLS, but more accurate, actually, than the ADP when you look at projecting, came in a lot softer and set. So yields spiked on Thursday, and then we had a little bit more coming back down to earth with Friday's numbers. But the Fed, looking at 25 basis points in July, all but locked now, as that solidifies that. Now, the good news is that nobody made projections onto September's just yet, thankfully. I believe it's September 20th. And we're going to call probably for a non-hike. And here's some of the reasons. As we look at inflation now, although we've been talking about being persistent, we think that the fever may be breaking. So let's start off first with money supply, right? So we look at money supplies, the M1s, M2s, all of that, right? We're not talking about BMWs here, folks, so calm down, gentlemen. But money supply globally has been decreasing. So there's less money moving around the economic systems. And of course, when you look at that, less money chasing far too little goods, that's better than too much money chasing far too little goods, right? And speaking of goods, the supply chains from pre-COVID starting to normalize. Can you believe it? Remember all the containers and all of that in 2021, all of that stuff, we're starting to normalize. So what happens there again, those bottlenecks start to free up a little bit, then we see again less inflationary pressures as more efficient trade can take place. So that's another bright spot there. Now, some of the other things that we're looking at on top of that is that when we start to also look at what's a 70% component of the GDP is what they call the Supply Management's PMI, Producers Management Index, and that has been on the decrease as well. So that is a pretty important component that we look at, that PMI, when we discuss that, because it is, like I said, 71% of the GDP makeup. Now, another statistic, who am I, Mike Tyson? Just kidding, folks. But another statistic that we look at essentially is the owner's equity market value index and as such there. And this is kind of fictitious in a way because what it does is it asks owners of their homes, like yourself out there, right, how much you think that you would pay rent for your own home. So it's almost a made-up metric. However, it's a pretty good indicator and pretty good mix there in the GDP number, so we mention it. And that does show that, again, home prices are continuing to soften. Now, of course, we saw home prices really take a hit over 13 months ago and as such, and we've started to see some rebuilding, and builders have been doing well and all that. So let's put it into context. The reason why new building and new starts have increased so much is that there's too little supply out there, which has kept prices buoyant, but also kept some of the, some of those builders and as such busy. That being said, prices starting to cool down there as well, and then some of the other things that we're looking at on top of that is, a situation where, again, we have the credit situation now creeping in. So everyone's talking about recession 24. There's not going to be any decreases in rates this year from the Fed. That's a given. Have we already had rolling recessions? You don't really know of a recession until it's already happened, which we think we've spoken to in the rearview mirror. However, we're starting to see potential, tightening of credit and as such out there with some of the banks. Now, Janet Yellen has indicated expect to see potentially some banking consolidations towards the end of the year, and which is a nice way of saying failures, falling into the arms of larger banks. But that, again, that tightening also it will weaken the inflationary pressures as well. It's that fine balance, right? Walking the line and a hard landing, soft landing, who could tell at this point? What all that means, however, is, again, when we start to look at markets, tying all this in, what you folks care about out there. Again, bonds had a little scare last week, right? Bonds over the last 2 years, with these raising rates, really ended a multi-decade party for fixed income. And now you see yields that are pretty attractive, even on a short part of the yield curve. But we still have what we call an inverted yield curve. We've already discussed that, right? Short-term rates, like the 2-year, higher than the longer-term 10, 20, and 30s, which is a forebearer of weakness and a recessionary environment where the bonds are a pretty good predictor of this. It's just the timing that you got to watch. With that being said, markets had a little pullback, rightfully so, probably overbought from Thursday, but then kind of gained their footing. So two positives on the equity side is the S&P 500 remains above its August of 22 highs, which again, if you remember that was the pre-Jackson Hole debacle. And then also since this February, consumer discretionaries, right? Think about, leisure stocks or luxury items versus more home, household good items. So discretionaries versus staples. That trend of discretionaries versus staples is still above its February high, which is also positive. So as long as those two things hold, we still have a risk on basis, and bias on that basis rather, okay? So with that being said, across the strategies, we've seen active capital preservation, pretty conservative. That is a mix of fixed income. Of course, it's been a mixed bag with fixed income this year. Some gold and some hard assets. Not really any of your commodity type, energy type situations there. However, increasing some of the more conservative equity exposure as well to take advantage of some of that, what they call risk premium, to balance that out. Opportunistic growth in income, global macro tactical, and the all-stars, the NASDAQ top 5 strategies, all doing very well this year. Optimistic growth in income, which transitioned from more of your cyclicals to more, again, a combination of technologies and as such about mid-spring. Doing well. Global macro tactical has been in AI really since the beginning of the year, taking advantage of those trends. And then when we look at all-stars, of course, the NASDAQ top 5. Now, a lot of you folks have all-stars. It's a very small percentage of your portfolio. As you'd imagine, 5 stocks on the NASDAQ, pretty aggressive, right? You think of a Lamborghini, you want to be driving that on the Autobahn, so to speak, not in a school zone. So thus, that's a smaller percentage of your strategies, but you'll notice within your sleeves, that's been a nice boost as well, as that has really kept pace with the aggressive indices this year. Sector momentum, macro momentum really started to really kick it in a high gear also in the spring, coming as a longer term indicators to the bull side started to wake up, no pun intended, during the springtime as well. So again, as a whole, more in the risk on mantra with the caveat of a brake pedal there, given depending on, again, if we see especially fluctuations with the yield curve, what the Fed needs to do with some of this data. And speaking of the data, and I'm going to finish with this, who's your data moment, is inflation. So we just referred to what are the things that could be softening it up. Again, the Fed wants it down at 2, right? Probably unrealistic. We've been talking, however, trueflation has it in the mid-2s. The government has it in the 4s. We think the next reading could be in the 3s. You heard it here. Maybe not first, but you heard it here on this channel first. There you go. Maybe in a 3 handle. Not so bad. That would generally give green shoots to the upside as well. So with that being said, if you're on a cruise ship, if you're on a beach, if you're in a hotel, if you're in a lobby somewhere enjoying family, some warm weather, keeping cool in the AC, perhaps with a cool drink. As always, stay frosty, and we will talk to you next time. And, again, try not to sweat the small details, as this market is a veritable washing machine. But at least this year we're ending up a little bit more fluff and fold than wet and soggy.